Good day, investors. Today we are looking at ARC Resources, which is a Canadian company producing oil and gas. We are going to look at it from the lenses of meaning, do I understand what the company does and how it makes money? On the moat, does the business have a lasting advantage that competitors can't easily copy? Management, are the people running the company skilled, trustworthy, and good at allocating capital? Margin of safety, am I buying the stock at a price low enough that I'm protected if things don't go perfectly? So ARC Resources is a Canadian natural gas condensate producer, so concentrated in Montney in the Montney formation. The business is simple. It produces low-cost natural gas, sells it domestically and internationally, and aims to get exposure more to LNG markets. Investors are essentially buying into the future of North American natural gas and LNG demand. ARC Resources has around 476 million shares outstanding and the market cap of just below 15 billion. Today, I think it's 14.3 or 4 or something like that. With a 3.1 billion net debt versus an enterprise value of 18 billion. But if you look at debt to equity, also we'll see later, it's really underlevered, so they are really safe. They have a strong balance sheet. The company currently pays 21 cents per share, which is a 3.3% yield, but do not be deceived. This yield is just what they pay as a dividend, and they have a relatively low payout ratio, but they are buying back a lot of shares. So on the production chart, ARC stands out as one of the largest Montney producers, especially in natural gas. You can see their mix and then how they look like here. So they are above peers. What matters for me especially is what's the mix that they're producing. If you look at the company's production overall, this was Q3 production, but overall for the year is a bit lower because they are growing. So usually every quarter is higher than the previous. The mix is around 60% natural gas and 40% oil. If you look at the barrel of oil equivalent, they have a reserves as of 24 of 2098 billion barrels, which is roughly 16 years of production at 2024 level. So we will see the 2025 numbers. So far, they've been increasing their reserves every year with the increased production. So basically, reserves divided by production, so the life of their reserves were kind of flattish around this like 16 to 18 range, years of range. Okay, so looking at the stock, the price has moved in cycles basically with oil and gas. You can see a couple things. So first you see the boom, which ended in 2014, late 2014, with the shale boom ending, and you had oil prices going down until they bottomed in 2020, right? So 2020 was really when you hit really the bottom. So if you look at, I don't have oil prices here, I just have gas, but the oil kind of trended the same. And if you look at natural gas, you had this spike with the Russia-Ukraine conflict, and then this is natural gas in the US, so this is a Henry Hub number. So natural gas tends to be more regional. But I found Henry Hub is a good proxy how ARC moves, basically. But they have exposure to natural gas. We'll see exactly how. So they are moving with the underlying commodity prices, and that's a catch. And we'll see a couple slides later, so I'm not gonna spoiler you anything. Okay, so ARC delivers energy at a low cost and has a strong pipeline access across North America, giving them flexibility to market routes. This is really crucial because unlike oil, natural gas is a bit harder to transfer, right? So you need LNG plants where they liquefy them it's really cold and high pressure, and then they move it across regions, or you have pipelines, right? Oil is a bit easier. So you have these regional pricing. So for example, you will see in movies or just videos of oil producing sites that they're burning natural gas sometimes because they cannot really move it away, so they just burn it away. So about half of their gas is sold in the US, and 25% is tied to global LNG pricing. So they are not exposed really to the AECO Canadian local prices. So this offers upside for international prices to remain strong. The inventory chart on the bottom shows that ARC has one of the longest oil and gas inventory lives. So I think this is oil. yeah, not gas, yes, and can and the low, and not just long life, but a long low cost inventory base means that ARC can keep producing for many years, even at the lower commodity price compared to some of the peers. So they are in better position to withstand low oil prices than some of their, especially shale producer competitors. Looking at their natural gas exposure, and I think this is the best chart, best two charts you will see. ARC becomes more exposed to floating and international pricing over time, especially after 28. This means a higher upside if global prices remains or stay strong, right? Or even get better. And as current outlook stands, natural gas, so there is a really strong business case if you think about it, that you have, let's say, if you look at the bottom, natural gas price realization versus the benchmark. So they're using AECO as the benchmark, and over the past decade, they usually have a 35% premium over DECO. As you can see here, probably even more than 35%. So that means as they can diversify from AECO pricing, they can get better realized prices. Why is that the case? Because you have a lot of gas in Canada, but they were lacking infrastructures to move that gas away and sell it somewhere else. Because if you think about just the really easy, simple case today, and since actually 2022, is that Europe doesn't have really gas, aside from Norway mainly. But Europe doesn't have gas, it has a lot of gas demands. Russia supplied the gas. Now with Russia gone, from the European mix mostly, where do you get the gas from? In the US, maybe you can, today it's about 4, but you could sell gas for 2 and sail it to Europe and sell it for 11. So, or even more during 2022, right? So let's say you have gas at home, 2, and you can sell it across the ocean for 10. Easy math, 5x. You have maybe cost of the LNG and everything for 2. It costs you 4, you can sell it for 10. That's your business case. Canada is in the same situation as the US was, except they have less infrastructure to do that. So the potential is to unlock more infrastructure and do that. And not just to Europe, but to Asia, so globally. That's where the natural gas financial exposure mix come into play. You can see that they can get more diverse pricing, and then a market basically balances out, and technically this should drive profitability for them. Okay, so looking at management, we have short-term and long-term incentives here. So ARC.TO pay basically to production cost per barrel, which is really good. Operating expenses per barrel, really good. Quality of execution, it's kind of like WAG. Development planning, semi-WAG, right? So these are really good. Net debt, so you have all the good cash flow per share. So these are all really good metrics for running a business. So what would be a red flag for me is if these would be tied to like share price performers, or everything would be EBITDA based, where management has more leeway to manipulate numbers. Of course, these are not necessarily GAAP numbers or IFRS accounting terms, but you get the picture. And then when you look, this is short term. If you look at the long term incentive structure, you see the 3-year average score based on achievement on STI. So STI is short term. So basically you have a 20% weight for the long term, also based on what the short term is, right? And then you have strategic area, commercial activities and risk management, right? Strategic financial sustainability and return investment. So you have TSR, so total shareholder return. You want to compare yourself to peers, right? So if the whole industry is doing poorly, everybody lost 50% and you only lost 20%, then you're outperforming, right? And you have to add some ESG and people. This is from 2024, maybe 25 it changes, but it's kind of industry standard. Overall, this is pretty good. And as Charlie Munger said, incentives work. So here they seem structured to drive efficiency, growth, and capital discipline, which I like. Overall, when you look at management and when you look at the management compensation related dilution risks, so if you look at stock options diluting the shareholder, options related issuance is being around 2-4% of the buybacks. So they are doing not too much dilution to the shareholder. What I saw And of course, it's really famous for the 2000 bubble, that these tech companies paid a lot of options and that they were diluting the share base. So they were doing buybacks of, let's say, they buy back 100 shares, but they issue 50 more through options to management. So basically, they are diluting you. For them, it's not the case. It's a fraction of the buybacks, and overall shares are declining. I saw peers in Canada where they are like 10-20% of the buybacks, right? Of course, they are also doing more buybacks than those companies, so you can compare it. But management here seems to be having a good incentive structure, business-oriented structure, and they are not diluting you and not overpaying themselves relative to market. That said, most directors hold well above minimum share ownership levels, showing strong alignment with shareholders. They are shareholders. Some board members even hold 20 to 35x their required amount, signaling a long-term commitment and confidence in the business. You can see a couple like shareholders here. Sorry, a few directors still have time to reach their targets until 29. But overall ownership looks healthy and shareholders aligned, so you feel a skin in the game by management. All right, so dividends are planned to go steadily with a 10% plus dividend growth target, right? And it's important to say that this is per share, right? And we'll see that if you have a payout ratio of 15%, then you have a lot of buybacks to do. So it's easier to increase your per share dividend growth. Share count trends down, showing ongoing buybacks, especially when the stock is undervalued. So here you see reduced share count when trading below intrinsic value. This is something you want to see. So if you read I don't know if it's the Security Analyst or the Intelligent Investor or some other books on investing, maybe you could tell me in the comments. I think it was the Intelligent Investor, that how you want to allocate capital is first, can I invest it in the business at a return on investment good enough to justify it? So if my whole return investment base is doing 15%, can I invest it at that base? Or maybe a bit below, but still, can I invest it with a good return investment? One. Two, if I can't, can I buy back shares, but only if it's below intrinsic value? If one is no, cannot reinvest, cannot buy back at a fair price, just pay dividends, right? So that's how you want to look at it. And what they are saying here is that we're gonna pay dividends with a 15% payout ratio, and we're gonna buy back shares. So they are saying that the company is below intrinsic value, which is actually, in the conclusion, it's a bit of a spoiler, but it is. So you have management with skin in the game doing buybacks and saying that, hey, the company is undervalued, which makes sense because management is not selling as of that chart. So the strategy focus on sustainable dividend, even in commodity down cycles, plus shrinking share base of shares outstanding. So you have outstanding shares, I'll have a slide here, peaked and then been going down, right? Plus boosting per share value over time overall. So this is like a tailwind for us, for everybody who holds this share. Okay, so free cash flow picture and dividend. So free cash flow has been strong and cyclical, right? Peaking in 2022, of course, with high oil and gas prices. Dividends remain relatively consistent and well below what the company is actually able to pay. So they can easily cover. From 2018 to 2024, free cash flow grew around 13% annually, compound annual growth rate, while dividends grew around 10%. So it's disciplined and shareholder friendly. So 2025 year to date, annualized. So this is a 25 Q3 numbers, just annualized. So multiplied by 1.3. Suggests that free cash flow could continue to trend upward actually faster, right? So you have relatively strong gas prices this year. And everything is dependent on the commodity price. All right, looking at the share count, you can see that share outstanding, it increased in 2021 and 22. Reaching its peak. This was due to ARX merger with 7th Generation Energy, which was paid largely in shares. After the merger, ARC began reducing shares through buybacks, so gradually you see a decline in share outstanding. Debt to equity dropped in 2022 with good cash flows, good commodity prices. They paid back a lot of debt. Although it came back up in Q3 this year, 25, but it's still manageable. It's still below 35%, so that's not an issue. And then you see production climbing relatively nicely. So what I would like to highlight is that from 2018 to 2020, basically 25 Q3, shares got diluted by 64.4%. So let's say 64% share dilution. But production grew by 175%. So from this point to this point, 175% growth. And overall reserves, I don't have it on this chart, but reserves grew 140%. So you see that basically this indicates equity-driven growth overall made sense in this case. You dilute 64%, you get 175% in production and 140% in reserves. So you get, for $1, you get $3 and $2. So you made a good deal. And we see since the merger, the company has been buying back shares rapidly. So all of these are really nice. All right. So looking at 2026 guidance, ARC expects production barrels of equivalent oil of 405,000 to 420,000 barrels of oil equivalent a day. So this includes natural gas. And so this is one. We're gonna use it for our discounted free cash flow formula. And then they expect a capex of 1.8 to 1.9 billion. So that's great. And then if you look at the more, so this is 26, if you look at their capex and production guidance going forward, so capex increases slightly toward 2027 and 2028 before leveling off in 29. Production trends upward, suggesting growth is funded by efficient capital allocation. So then you have this production growth, and then you have capex not growing as much, right, than production. Okay, so we're gonna actually use all of those in our projections. But first, let's look at this chart, right? This is from their investor presentation of November 2025. ARC has delivered an average return on capital employed since 1996 with around 12%, consistent with management's long-term look. But look, this has been volatile, right? My calculations actually for 2018 to 2024, so these two periods, 2018, 2024, show return on equity on average, this is averaging out the previous years, to be 12%. So it's, yeah. So it's kind of in line, and 25 Q3 annualized is more than 12%. So it kind of aligns with the company's long-term trend. You can see that, okay, we have it here. You have return on investment. What do I have here, which makes sense? You see their current ratio is actually a bit weak as of Q3, but it was healthy to 2024. There must be some seasonality going on, so on the year-end number is going to be more aligned. Although 2022, you see they were also in the 50s, so we'll see about that. I would prefer them to have a 100% current ratio, but I'm not sure how liquid they are and what are the credit facilities actually on that perspective. Their debt to equity was relatively low, 7.5%, which rose a bit to 33%, so that's actually higher debt to equity, but it's still manageable, it's still low, and their coverage ratio is really healthy. So like 13% for 24 and 16%. So if they are under levered, they have manageable debt. That's all good. Okay. Where the upside could come from? Long-term value creation. Yeah. One more before we look at the discounted free cash flow, is that overall, if you look at these historical return on equity or return on invested capital, right? You see that the return on investment capital, return on equity is only moderate, suggesting that ARC historically does not demonstrate a deep competitive moat. As of today and as of the past, returns have mostly moved with commodity prices. So you see this, you have pretty bad time here with the shale boom over investment. Then you have a spike, then it goes lower, and 25 fish is here. So they expect this. So It's volatile and it's not outstanding. But where the upside could come from is that long-term value creation will likely be driven not by the past return profile, but by the ability to sell Canadian gas at international pricing via LNG and improved market access to pipelines. So if midstream build out succeeds, so pipelines, LNG export capacity, and Canada enables rather than restricts it politically, ARC could unlock higher and more durable returns on capital. Canada needs to unlock its natural potential, and this company could skyrocket. That's the thesis. So now we look at valuation. So from a valuation perspective, it's a 60% gas and 40% oil. What I use is a ARC average barrel of oil equivalent price. It's easy for 25, right? We have the Q3 year to date number, we just annualize that, and then I project out all the rest based on a mix of how, let's say, Brent works, Henry Hub works, and then you need also an FX because they are in Canadian dollars, and then you end up with these commodity prices going forward, barrels of oil equivalent realized by ARC based on their mix and their their company specific mix and contracts and everything, and the Canadian dollar weakening against the dollar 1% for every year. So those are the assumptions. Using those assumptions, you also have the capex from the previous slide, and then you also have production growth outlook from the previous slide. So based on those, you have a free cash flow, which looks like this. If you discount it back, you see a 35 discounted free cash flow value. Now, you can also see that production grows from 0.36 to 4.10, which was actually their Q3 numbers, as we can see on the first slide. So they are, if they can just maintain what they did in Q3, that's their production, then these are conservative numbers. So this is not expecting really growth. It expects growth only in 24. Of course, 23, it's relatively weaker because you have production coming next year. If you only look at what cash flow is for 25, and you have a 10% return on that, because everything I discount is with 10%, then you will have a company valuation of 24, right? Their 7-year average value would be, let's say 12, 13, but it's a poor look, because if you look at the past this period, you have COVID, you have a weak 2019, and then they had much less production, right? They did a huge merger in 21, 22. So projections matter. I see those. If gas and oil prices mess up, go down way more, then of course this doesn't matter. I think this is relatively conservative, right? So 26, I use $60 Brent, and then 70, and then 80. This is really conservative. This is what we see for 25 so far. Gas is already above 4 for the Henry Hub, so it's kind of moving around, but everything depends on prices. If you believe that natural gas can go higher and oil can recover, you see these oil glut stories for 26, but then you go to OPEC or go to Chevron, you look at their projections, they see a shortfall in the mid to long term. So short term, sure, 26 probably a glut, 27 less so. And then you will see prices pick up, and then you will see these companies' cash flow pick up. And of course, you have the natural gas angle. You hear people you hear Bloomberg talk about, okay, natural gas is really cheap relative to oil on an energy basis, so on a BTU, British Thermal Unit basis. So natural gas should rise and oil should come down. They are natural gas heavy. So you like these long reserve life companies with a mix of natural gas and oil. If you're more bullish on natural gas, it's actually good that they are more heavy on natural gas, and ARC is 60% natural gas. So the discounted free cash flow suggests upside. If growth sustains and LNG excess materializes, then you have huge upside. So if gas is, like, I used 3.7 US Henry Hub, it's already above 4. I haven't checked today, but it's like 4 point something. We saw a couple of slides ago, like upper parts of 4. So I'm already undercutting my natural gas projections. if it goes higher and sustains that, right? There are some seasonality, right? Because now it's up because winter hit really hard in the east coast of the US. But those are the moving parts. If I use the same commodity prices for all company comparisons, and that's why I think the companies can be compared to each other. Because if with these assumptions, let's say company 1 is having an upside of 50%, while company 2 has an upside of 0%, company A is probably better deal than company B. All right, to summarize, ARC Resources, straightforward business. It is producing and selling 60% natural gas, 40% oil. If you want exposure to Canadian natural gas, there you go. On the moat side, doesn't really have a durable moat. Historically, they have relatively poor return on equity and investment. Not poor, but average, like 12% return on equity. Driven mainly by commodity price swings, so they don't really have pricing power or any real advantage. But they are not the lowest cost producers, like not the Saudi Arabia. And the future profitability upside really depends on midstream expansion. You want to have pipelines, LNG. For those, you need strong natural gas prices and Canadian government policy support. Although they have good reserves and a really good balance sheet. Management incentives look well designed, business aligned, focus on low debt, production efficiency, low operating cost, total shareholder return versus peers. They're buying back shares since the merger, which is helping your reuse outstanding shares. So per share basis, they're gonna perform better. That's a tailwind for the per share. And of course, directors have good amount of equity. So they have skin in the game. At the margin of safety side, it's attractive at current valuation. ARC trades below intrinsic value using conservative pricing assumptions, with buybacks reducing share count and no aggressive dilution. More just the reverse, the opposite of that. They are reducing outstanding shares. So long-term holders benefit unless fundamentals really deteriorate, which would be commodity prices swinging down, or maybe a bad M&A or those kind of things. This is a solid option if you want to have natural gas exposure through Canada with some oil, but valuation is still tied really to commodity prices. So if gas prices move sharply or oil in either direction, intrinsic value estimates change immediately. That's the risk and the volatility with playing with commodity companies. All right, putting ARC Resources into perspective, among the companies we've reviewed so far, you see it's relatively up there with the potential upside. I want to mention that recently I made changes to my models to account for the oil and gas mix they have in the portfolio. So before that, I just used historical barrels of oil equivalent and then used just oil forecasts. Now I do it with a mix of oil and gas. And also gas is different for different companies. So let's say Shell is using Henry Hub and also local European gas prices. So that's what changed with the model. So now you have a mix of oil and gas production driving those models. Petrobras is like 80% oil, 20% gas, Equinor 50-50. So that's the story. Other than that, I use the same oil and gas prices for each category. So the ruler is the same. The approach is the same for all companies. Technically, that would result in getting a relative picture of which company is good or bad, right? And of course, if you look at Petrobras, this upside seems huge, right? But you have to keep in mind, everything is using a 10% discounter. So maybe you want to use 20% on Petrobras. Maybe it's only 90 upside 90%. And of course, Petrobras has a really huge production growth projected, especially on the years where I use higher oil prices. So 27, 28, 29 and out, you have technically oil prices recovered, right? But that's it. If you enjoyed this video, please like and subscribe. And let me know down in the comments any stocks you want me to look at. I have a couple more Canadian companies I want to check out in oil and gas. And after that, probably I will do a video where I compare all the oil and gas companies we have looked at. Not just Canadian, but everything. That would be it. Thank you for watching and have a nice day. Cheers.